Good morning. We are live. It is Monday, August 26th. This is the Deep Dive with Keeping Current Matters. My name is Kate Rezebeck, and I'm thrilled to be here with you this morning. We have a great deep dive set up for you, talking about what to know about the next Fed meeting. There's been so much information, even over the past week, that we want to bring to you, share with you. So you don't just know what's happening, but you're also able to explain it to your clients, what it means for their home ownership plans, what it means for mortgage rates, all the different things. So our research team has put together a great deep dive for you this morning, and I'm really thrilled to be here. As always, remember, if you're a KCM member, you can download these slides in the member area. They are there for you. If you are not a KCM member, no worries. You can find these slides by going to trykcm.com. Great place to get them. And, we want you to have these slides in your hands because there's a really big difference between telling your clients what's happening and showing them what's happening. When you can show your clients exactly what the economic data looks like, explain it, what it means, that's the game changer. And that's why we always say most agents know what's happening, good agents understand what's happening, but it's only the great agents that can explain what's happening. And that's what we want to help you with today, is really explain, what does all this mean for your clients, for their home ownership plans, for everything that's ahead through the rest of the year into next year. We've got a lot of great data to share with you, and I want to make sure you have that in your hands. So the impact on the housing market is what's most important, and that's what we're really going to break down today. So we're going to go ahead and get started. And we're bringing you this information today because everyone has been eagerly anticipating the next Federal Reserve meeting coming up in September. There's been a lot of chatter about what's going to happen. Is the Federal Reserve ready to start lowering the federal funds rate? What does that mean for mortgage rates? What we have to remember at the end of the day is that the Federal Reserve does not set mortgage rates, but their actions on the federal funds rate really indicate what's happening in the broader economy. And when that happens and they make a move, then mortgage rates tend to respond. So we're going to break all of that down for you. And I want to start with a statement that we heard from Federal Reserve Chairman Jerome Powell just late last week. He said, "The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks." So there's a lot packed in there. What does that actually mean? I think that the New York Times summed it up really well with this headline here. It says, "Fed Chair Powell signals time has come for September rate cut," meaning September meeting federal funds rate cut. So what the Federal Reserve has been doing is looking at all of the economic data, everything that we've been sharing with you, from inflation to employment data. They're seeing the trends that they're looking for. And what it means is they're signaling that it's time to start potentially cutting the federal funds rate. And that's going to have an impact on what we see in the housing market. So what I want to start with today is breaking down three of the big things that they are looking at: inflation, unemployment rate, and the jobs report. I'm going to give you visuals to be able to see what's happening, so then you can explain it to your clients. And later in the deep dive, we're going to get into what does all of this mean for the housing market. So let's start with the first one. This says inflation is approaching the target rate, and that target rate is 2%. So if you look at this graph, what it's showing you is that inflation has been, pretty high over the past couple of years. You've heard us talk about this a lot. What the Federal Reserve did was start to raise the federal funds rate to start to slow the economy and aim to bring inflation down. That's part of their dual mandate, it's called, where they're trying to bring inflation down and monitor the unemployment rate. So as they've done this, we've seen inflation start to ease, particularly over the last couple of months. And what they've been looking at very closely is inflation getting closer to that 2% target rate? They've been very vocal about making sure that they're seeing a trend, they're seeing a continued pattern of inflation coming down, and that is what they are seeing now. So that's one of the reasons why we're seeing a cooling economy, and we're seeing that the Federal Reserve is getting ready to cut the federal funds rate. So that's the first piece that they're looking at. The second piece is the unemployment rate. And this shows the unemployment rate rising, but still below average. So they've been looking for the unemployment rate to tick up just slightly. And ever so slightly, what you can see over on the right side of this graph is that the unemployment rate has ticked up to about 4.3%. That's been the latest reading. So with inflation coming down and employment just easing up a little bit, they're starting to see that balance that they're looking for. Now, unemployment is still strong. So it's strong but cooling. Haven't reached that average 5.7% rate that is, many, many decades of average unemployment rate. So still strong employment, but easing up in the direction that they're looking for to show that cooling economy. So those are the first two things that they're looking at. And the third one is the jobs report. And this quote from JP Morgan says, the July 2024 jobs reports, that's the latest one, shows signs that the labor market is cooling down, but remains stable. The US labor market added 114,000 jobs in July, much lower than expected, and the 179,000 rise in June. The July jobs report underscores that the labor market is moderating, making a September interest rate cut from the Federal Reserve even more likely. So we're seeing that, fewer jobs than expected added to the labor market. That's another sign of a cooling economy. That's what they're looking for. And with these three factors in play, inflation coming down, unemployment strong but slightly rising, and then the jobs report, the Federal Reserve is seeing the data that they're looking for to start to make rate cuts. So what do economists think? Well, take a look at this quote right here. This is from money.com, and it says nearly 80% of economists surveyed by Bloomberg recently predicted the Fed will make a quarter-point decrease to a range of 5 to 5.2% in September. So economists have been following along on this with this data like we have, sharing it with you, seeing kind of these economic metrics come in, seeing this slowing, cooling economy, the signs that we're looking for. And nearly 80% of them believe that, this rate cut is coming. So this is anticipated. This is something that, experts are really seeing, yep, the writing is on the wall. The Federal Reserve has come out and said, I think we're ready. And so we're moving toward a September rate cut. Now, how big might that September rate cut be? Well, if you look at the CME Group Fed Watch tool, this is something that we monitor regularly, really on a daily basis. The latest reading we saw this morning is at 65% probability that we'll have a 25 point basis cut in September, and 35% probability that it might be a little higher than that, might be up to 50 basis points. So how much and how far is still up for debate. The Federal Reserve will ultimately decide that as they come into this September meeting. But economists are thinking it's probably somewhere between 25 to 50 basis points, leading more towards the 25-point cut side. So what has this looked like over the past couple of years? I want to share this with you. The federal funds rate change and projections. So if you go back to March of 2022, you can see on this graph that that's when the Federal Reserve started increasing the federal funds rate. They wanted to slow inflation. They wanted to see cooling signs in the economy. What that did is that started, this response with mortgage rates, where mortgage rates climbed higher. They don't set the mortgage rate, but it certainly is that economic indicator, and mortgage rates respond. So we saw high mortgage rates through all this time going back into March of 2022. Now, what we've seen over the past year is that the Federal Reserve paused those rate cuts. They said, okay, we're moving in the right direction. Let's take some time. Let's watch the data. Let's see what happens. We're not ready to cut yet. But when we see those economic signs of inflation cooling and in the job market, then we'll start to cut the federal funds rate. And so the projection that you can see over there in that light green is that that first cut may likely come in September. That's the indication that they've given us. It's what expert economists are projecting. It's all the factors are starting to come to a head. Now, is it one cut? Is it two? Let's break this down. It might be more. As Lawrence Yun, chief economist at NAR, says, generally the rate cutting cycle is not a one and done. 6 to 8 rounds of rate cuts all through 2025 look likely. So this is a long process. This is where, that first quote that I showed you said it's going to depend on what the economic data continues to show. We're going to continue to follow that for you, so you can explain to your clients, what's happening. There are 3 more meetings for the Federal Reserve this year. They're anticipating the first rate cut in September, but how many and how far is yet to be determined as they continue to follow the data. And what you can see right here is that the chief economist at NAR says it could be 6 to 8 rounds over the next, through 2025. So we're going to continue to keep you updated on this, because what happens will ultimately impact some of those pieces of the housing market that are really important to your clients. And that's what I want to dive into now, is how do you help your clients understand what's happening, why, and what it means for their home ownership plans. And I think this quote from the chief economist at MBA says it really well. Once the Fed kicks off a rate cutting cycle, we do expect that mortgage rates will move somewhat lower. And so I'm going to show you what the projections for mortgage rates look like through the rest of next year. We've got 4 great entities that have projected out that far. Keep in mind, mortgage rates are some of the hardest things to project in the housing market. So all of this is dependent on what happens in the economy. But I'm going to share that with you in a moment so you can see, what does it mean that mortgage rates will move somewhat lower? And keep that word somewhat in mind, because I want to double down on that in a moment. This is a look at mortgage rates and projections going all the way back to 2018. So that orange line, that thick line, shows mortgage rates going back to the first quarter of 2018. And you can see how they really dropped down in 2020, 2021. That's when we saw those historic lows. And then we had that historic climb up where mortgage rates more than doubled in a year. It was the fastest climb we've ever seen in a year. And now as we look ahead into what the projections are, we can see that mortgage rates have started to come down. Even over the past few weeks, we've seen this a little bit in the housing market. And experts project that they will continue to ease through the end of next year. Now, keep in mind, we've seen mortgage rates ease over the past few weeks because we've been seeing all of this economic data coming in, from inflation to employment, all the stuff we showed you at the beginning of the deep dive. So when that happens, mortgage rates start to respond. And what you'll see is that mortgage rates are expected to continue coming down through 2025. But keep in mind, some of this price adjustment has been priced in. Some of these, this downward movement has already been priced in. That's why we've seen some of the easing on mortgage rates over the past few weeks. So mortgage rates expected to continue to come down through 2025. That puts us roughly at the low 6s, so a little bit lower than where we are right now. We're going to continue to monitor that, and it's all going to be based on what happens in the economy around us at the same time. And I think this quote from the Associated Press says it really well. A rate cut by the Fed is unlikely to have much immediate impact because it is largely expected by financial markets. Yet over time, lower Fed rates should reduce borrowing costs for consumers and businesses, including mortgage and auto loan rates. So we've seen some of this initial easing baked into rates over the past few weeks. We expect to continue to see it as the Federal Reserve continues to work on cutting the federal funds rate, and we look to see easing inflation, and we look to see unemployment, moving in that direction. But some of that pricing has already been priced into the financial market. So what we're not talking about is a massive drop in mortgage rates. If you have clients that are waiting to see those historic lows again, that's not the direction that's projected. But an easing, yes, over the next year, that is expected based on the best information and the best data that we have right now. So it's really important to continue to talk to your clients about this. Make sure that they understand, just because the Federal Reserve is meeting in September and they expect to cut the federal funds rate, that does not mean a massive drop in mortgage rates. So if you have buyers in particular who are ready, willing, and able to buy, we have inventory rising, and they can jump in now and find the home that they're looking for. This might be a sweet spot right now. We've been talking about that inventory sweet spot quite a bit. But keep in mind, as mortgage rates continue to come down, you're going to see more buyers jumping back into the market. That creates more competition, ultimately upward pressure on prices. We do see inventory rising right now, which will help a little bit but it's not a big flood coming to the market. So while we may see a little bump in affordability, mortgage rates coming down is always good for the market. That means more transactions, but you got to communicate with your clients and help them understand, what does this mean right now? And what does this mean going forward? Because they need your guidance right now more than ever. And seeing all of this in the news can get super confusing, not sure what it means. But when you follow along with a deep dive, we give you the information you need to be that expert for your clients, help them understand how to make the best possible decisions. Because bottom line, you hear us talk about this all the time. This quote says, timing the market is basically impossible. If you're always waiting for perfect market conditions, you're going to be waiting forever. Buy now only if it's a good idea for you. You've heard us say this before. It's not about timing the market. It's about time in the market. And if you can help your clients understand, what does it mean to be in the market, to grow that equity, to have, that net worth boost by being a homeowner, that's fantastic. But timing the market to find the absolute perfect mortgage rate, that is a really hard thing to do. So have those conversations with your clients, equip them with the knowledge and expertise that you bring to the table, so they know that you're their expert guide and you can help them through this every step of the way. And one of the things we always love to do to help with that is to give you the resources that you need. You've got the slides that you saw here in the deep dive today, but if you want to go talk about mortgage rates with your clients, some of the best conversations can come out of staying up to date on the KCM blog that you see here, the social graphics that you can share on your Instagram, and then real talk scripts that you can record. When you can get out there on video and talk about this, we've put together the expert script for you so you can have that conversation. Again, if you're not a KCM member, try KCM.com is the place to go. If you are, this is in the member area for you. So please go check it out. Enjoy. Thank you for being here with us this morning. It is always our pleasure, and we can't wait to see you again soon. Keep in mind, next week is Labor Day, so there will not be a deep dive next Monday, but we will be back on Monday the 9th to keep you informed. Thanks so much and have a great week.